Biggest question that we're running into every single day with leaders of design and construction companies is interest rates. How are they going to change? When are they going to change? Biggest question, how is it going to affect your clients, your markets, and your projections, even to the tune of stuff that you may have in backlog? We're going to tackle that today and a few other topics in the PioneerCast. Welcome to the PioneerCast. I'm Dwayne Abels, founder and president of Pioneer IQ. I hope over the course of the next 5 or 6 minutes, we're able to give you some insights on how your markets could be changing to help you better prepare your leaders and your teams to take advantage of opportunities that could be sprouting up in your markets. Also to figure out anything that you may need to do to pull back in certain situations as well. To help us again today, Keith Prather is joining us. Keith, thank you.
Oh, you bet. Glad to be here.
Okay, so I literally just got in late last night from Vegas, was at a large multinational construction event, had both business owners and labor unions represented in this big conference. And I got to tell you, interest rates is probably one of the biggest topics. So I'm really grateful we could jump on here first thing this morning and get a little bit of content out to our clients, just helping them understand what's going on with interest rates, when they might be able to when they might be changing, and what to expect from a project volume scenario long term.
Yeah, so there's an old joke, right? Ask 5 economists and their opinion on something like interest rates, and you'll get 6 answers. Seven if one of them went to Harvard. So there you go. So this is the big topic. And yesterday, as we're recording this, the Federal Reserve is actually doing their March meeting. And so they're setting interest rate policy. And we all know that at this point, they're going to take a quarter point hike, which is actually a little bit less than what everyone expected. And because of that, that's why the market was up 600 points yesterday or the day before. It's like a slower moving Fed equals, better stock market environment. So let's show just a couple slides that we've got put together for this. Don't have a lot. This will be a really fast one. Basically, you guys know the story. So inflation right now, this is actually outdated. So we just got new inflation data, and it's actually right around 7.5% in the consumer price index. Core inflation is up around 6%. So these are the highest levels we've seen since arguably now we've got to go back before the 1980s. We're all the way back into, like the 1970s, 79, 78 before we've seen inflation this high. And with the situation in Ukraine, as you and I have talked about off camera and in another video that you and I have done, there's going to be some inflationary pressure on some core goods, especially oil. And that will push consumer prices up. I mean, oil touches everything. And then also on the food side, we're going to see some inflationary pressure there, which will affect the consumer price index. So what you could see the Federal Reserve do is they may start focusing a little more on core inflation. And core inflation is just a statistical measure we watch that includes everything except food and energy. And the only reason why they're watching that is just because they feel like people can figure out how to kind of work around some of that. We purchase less expensive food. It's not that we eat less. We just don't buy the high quality proteins. We buy lower quality proteins. We get our way around it. We drive a little bit less. This time, only 36% of U.S. office workers are back in the office from where we were pre-pandemic. So we don't have the same commuter traffic that we had before. So the impact from fuel prices is a little bit less. Anyway, make a long story short, the Federal Reserve is going to move cautiously, and they've said that again and again and again. We think that because of the Ukraine crisis and maybe the impact of what does actually happen with food and energy prices and what that does to inflation, is going to keep them moving a little bit slower than expected, again, which is why there's a lot of optimism in the market. So for perspective, I just wanted to show everyone this chart. So if you take a look at the federal funds rate, so this is what the Federal Reserve sets. And this is what banks, create from, they build their prime mortgage rate on top of that. And, that's where rates are set. So right now you can see that we're still kind of on rock bottom. We're still just barely above basically a flat or a 0% interest rate. As we start to take these quarter point increments, and the Fed is expecting right now to maybe take 4 quarter point hikes in 2022. Now, I've seen estimates as high as 5, and I've seen estimates as low as 3, depending on what happens in Ukraine. But what you would get at the end of 2023, not the end of 2022, but the end of 2023 would be where the red line is for interest rates. And the whole point of this graph is just to show you that in some of the good economic growth that we enjoyed in 2019 prior to the pandemic, we would have had higher interest rates than what we'll have after the Fed moves. So the Fed's longer term, their forecast or their target rate is 2.5%. That's the green line. So even if you think about like the housing boom and the construction boom we had in 2006 and 2007, look at where interest rates were. Interest rates were almost 5% at that time, and we were still growing right through it. So we still have a long way to go before we kind of hit some of those historical levels. And now I know, times are different and we have to acknowledge that, but consumers are still consumers. They still look like consumers, from years and years and years ago. And so we tend to spend and we tend to want what we want. And so, even with higher interest rates on things like home construction and housing, we're still going to go want that home that we want, whether the interest rate is 4% or 2%. And that was proof back in 2006 when we still saw housing demand just, off the charts. And as I go out and I talk, and maybe Dwayne, you're hearing the same thing, and I know that folks watching this PioneerCast are going to feel the same thing. But there are some projects that maybe interest rates will start to hamper. I know a lot of state projects really affects how much they can invest into those projects and changes how they allocate bonds and how much they can spend. And so we may start to see some of those projects either take on a smaller scale or maybe get temporarily put on hold. But most companies believe, obviously, that this is just the start, that interest rates are going to continue to go up for the foreseeable future. So the time to get in is now and try to get these projects underway, at least get them planned, at least get them started in 22 and 23 before we do start to see, the Fed try to approach that 2.5% longer run forecast. Now, again, the Federal Reserve, as I'm going to say in a little summary slide here, Fed is watching Ukraine very closely, and Ukraine situation there, specifically sanctions on Russia, could really change the inflation environment. We could see significant spikes to inflation, and that might change the Fed's attitude. Fed believes it really needs to move, but it needs to move fairly slowly. They need to do a measured approach. And what they continue to reiterate is that they can't do anything about supply side inflation. So let's talk about that for a second. Oil shortages around the world, shortages of oil that push the price up. Federal Reserve can't affect that. All the Federal Reserve can do is affect demand side. All they can do is go in and say, we need to slow down general demand around the country. We need to slow down people's desire to, to go out and purchase products or, to go do certain types of investments. And the only way to do that is to increase inflation or increase interest rates to pull that down. That's not necessarily where the inflation problem is. The inflation problem is still supply side inflation issues, and they can't affect that. So that's why they're going to go measured. That's why they're going to go slow. And then again, as we said, even with hikes, we probably are not going to revisit 2019 levels at least through mid 2023, unless, and there's that bottom line, that little caveat, right, that you and I we have to throw out there right now, unless something dramatic happens. And right now, unfortunately, we live in an environment where the unexpected happens and the dramatic seems to be happening. So we'll have to continue to watch it. I know you've said this before, but we'll keep doing these as long as we need to keep updating, folks on what's going on, especially with the situation in Ukraine and how it impacts construction. But, that's kind of where we are right now. I would say I'm not panicked at all about what happens with interest rate hikes. I don't like what I see in my stock portfolios, in my 401ks. That doesn't feel good. But again, even the stock market heard a very, what we call a dovish Fed yesterday, which means that they're going to go a little more slowly, a little more measured for now. And the market liked it. So it's kind of where we are.
So sorry about that. In general, Keith, when you're looking at the spectrum of things that design and construction executives are really kind of balancing and trying to figure out, labor shortages, supply chain issues, raw material costs, interest rates are kind of the four big ones right now that we're seeing. And it's a little bit relieving to hear the last 5 or 6 minutes from you, say that interest rates should not be as dramatically affecting design and construction as some people are concerned about, and maybe even some of what's touted in the news. So it sounds like you're saying bigger concerns continue to be labor and a couple of these other topics that you mentioned there, supply chain and raw material costs.
Yeah, absolutely. And yeah, you and I are counseling our clients right together on those things to say, if you want to lay awake at night and worry about something, worry about getting the right kind of steel where you need it, when you need it, at a price you can afford. Worry about having enough workers to be able to pull off a project. Those are two big things. On the supply chain side, there's probably a whole nother video, but I would say that congestion around the world is starting to show signs of easing. And as we process millions of containers off the coast, and as the demand side, we go into this seasonal lull, which we have every single year. We go into a little bit of a seasonal lull. The supply chain's catching up. And again, the Ukraine situation in Russia, sanctions, that's going to slow things down a little bit, but not going to be the kind of impact, not even close to the kind of impact that we have with COVID. So China's even now talking like they're going to move off of their zero COVID case policy. So I think China stays open. So anyway, global supply chain piece of this, even I think we can start to say that risk will start to come down. So I think the wall of worry really for me, as we talk to our clients, right? You and I are telling them it's really two things, and it's going to be finding good people and being able to procure the raw materials that you need. So and again, I think if the supply chain sorts out, I think the raw material side of it sorts out. So
Keith, thank you. Interest rates a big topic. We'll continue to monitor it and get back to you. Hopefully, over the course of the last few minutes, you've learned a few things that might help you and your team better prepare for and take advantage of shifts and changes in your marketplace to better prepare and serve your clients. Now more than ever, people need you. Continue, lead on. Thanks, Keith.
Very good. Thanks.